for many years, there was no way, no technique we had that could identify a higher withdrawal rate, a rational way to recommend a higher withdrawal rate than that 4 or 4.7%. We knew that historically retirees were able to draw much more, as high as 16%, believe it or not, back in the 30s, right after the bear market ended. But how do you go about confidently, scientifically saying to people, yeah, this is the time to take 6% or 7%? For example, at the end of the bear market in 2009, remember that terrible bear market? Yeah. I calculate that the retiree then probably could have taken 8%. And that's fairly recently. We haven't had too many in the last 25 years that could do that. So I spent many years looking for the holy grail of retirement income planning, which is how do we find a way to explain to clients or show clients this is a safe withdrawal rate, which is a lot higher than the 4%. And then one summer morning, I was sitting at this very desk back in 2021, and it just hit me. I knew that inflation had to be part of the factor because inflation turns out to be as important as the returns you get during retirement. The returns you get whittle down if you have a bear market, your portfolio. But if inflation is also causing you to raise withdrawals, it's also whittling down your portfolio from the other end. So I decided to put inflation first. For years, I've been putting stock market returns first, and it couldn't get anything to work. And then I put inflation first, and then second stock market, and then everything fell together. And so I use those two factors, inflation and the stock market valuation, and we look at those two at the start of an individual's retirement, we can get a pretty accurate representation of what their historical return or their withdrawal rate would have been. And probably to about 85% confidence, 85, which is pretty good. And we know that leaves maybe 15 or so % of situations where you're going to have to make an adjustment during retirement because we can't predict exactly what's going to happen. Things can happen during retirement, as in the 1980s investor, where the stock market goes nuts and you make money you never expected, and you have to make an adjustment for that. So that allowed me, finally, that discovery in 2021 allowed me to develop a fully blown process by which a client can, with confidence, develop a withdrawal rate and go forward into retirement, perhaps not facing such a huge wealth buildup as they might have if they settled for the worst case, 4.7% rule.
And so take us back to that. You said you put inflation first ahead of market returns.
That's right.
Let's double click on that a little bit. What do you mean by that?
Okay, for years I had been sorting my data first by stock market valuations, using what's called a Shiller-Cape, the cyclically adjusted PE ratio, putting that as the most important factor, and then not really knowing what to do with inflation. I sorted by inflation after that, and the numbers came out a jumble. There was no pattern. There was no way to develop anything that had a reliable forecasting value. But when I reversed it and I made inflation the primary variable and sorted within inflation by CAPE, by PE, that created a couple of charts for each inflation regime: low inflation, moderate inflation, high inflation. Depending upon which bucket you're in, you can now get a very reliable indication of what your withdrawal rate should be if you know the valuation of the stock market at the time you retire. It's amazing how much it improved the forecastability of that, the two-factor model.
And that, when you made that discovery, that led you to 4.7%, or you'd already arrived at that
Yeah, I'd already
conclusion?
been moving up as I added more investments to the portfolio. It was rising steadily, and I got to 4.7% probably just shortly before that discovery. That discovery didn't affect, what the withdrawal rate was. It was 4.7% represents a worst case for just one retiree, and that hasn't changed. What did change was my ability to basically recommend to people with confidence what your withdrawal rate should be based upon market circumstances and their own customizable factors.